So can passive real estate losses actually offset your own capital gains? Well, there's some yeses and nos in this, and I'm gonna go into this video about what that is. All right, so I get to ask this question all the time. They're like, hey, I've got these passive real estate losses. Can I actually use these to offset my other income and capital gains and things like that? Well, I'll tell you, that's a very common question. And there's some exceptions. There are some rules that you have to follow to make sure it works just right. Some things are good, some things aren't. So let's talk about the capital gains. And remember, this is 2024. Tax rules change all the time. My ultimate advice to you is talk to a tax professional. But in the meantime, let's talk about how you can actually offset and even save yourself a lot of money on taxes. All right, so when it comes to capital gains, right, it's what's the net gain or net loss that happens. So with a real estate property, if you end up selling that property and there's a net gain on that property from what you bought it for compared to what you sold it for, that money can be taxable. Now, if you've done other things too, like you've been depreciating the asset, things like that, that number on the bottom side kind of goes down. You could have more there. Now, just so you know, capital gains are actually not so bad. If you're going to get taxed at all, it's better to have capital gains than it is to have actual income taxes, right? A lot of times you can be taxed up to like 20%. And again, these rules can change year to year just depending on the year that you're in. But 20%, could be a lot. It could be less. It could be actually zero depending on how much those capital gains are. Just know that there's, again, levels of different tax brackets you could be in. So again, talk to your accountant to see what works, because sometimes you may not have any capital gains on that sale. So you may be worrying about something that you don't even have to worry about at all. But in other cases, you might want to try to do some of these things to avoid on these taxes. And remember, capital gains not just applies to real estate, it also applies to the stock market too. All right, so we know that we can have capital gains. You can have that on stocks, you can have it on real estate. Now, when it comes to capital losses, there are some limitations here, okay? Because you can't write off everything. So for example, like in the stock market, if you have a capital loss, you can only write off $3,000 per year. This is one of the reasons why I kind of hate stocks, okay? I mean, it's kind of cool if you do have stocks. This is not true with 401ks and IRAs. You don't get this benefit. When you have normal stocks, normal mutual funds, you got things like capital gains that are involved, those kind of taxes, if you cash out. The thing is this, is that if you lost $100,000, it's going to take you, if they don't change the rules, 33 years of carrying over losses year after year. And yes, you can carry over passive losses, right? You can carry over those losses on your capital gains or capital loss, right? Again, you have to lose on investment to do that. In real estate, it's a lot more rare that you have a capital loss, but it can happen. Now, real estate's bigger. Real estate, the max that you can actually write off is $25,000 per year. So you get a little bit more leniency because, of course, real estate usually has a lot higher fluctuations. But again, real estate, it's pretty rare you're going to have a loss that happens. But when it does happen, it's nice that you do have that option. Now, most people, though, they're not usually worried about the capital loss, right? But they're more worried about, like, what can I do to offset these gains? Now, it's true, when it comes to capital gains, if you have capital gains in an area, you can use those capital losses to offset them. So sometimes I'll have people, even though you can't write off a lot, sometimes people will lose money in the stock market and they'll use that to try to offset some of the gains in real estate. Like I said, $3,000 a year max doesn't really give you a whole lot to work with, but it does help. Same thing if you have a real estate property that maybe you're just done with, and maybe it didn't really make you any money, right? Maybe with all the expenses and everything else, even though you might have had a gain on the appreciation, maybe has some losses from other expenses like coming out of pocket. You can write off a lot of things like maintenance, other issues when it comes to like renovations, when it comes to like trying to evict your tenants and people like that. Those can compound to create a loss, and thus that can offset your other gains that you have. So sometimes I'll have clients that, and again, in the rare case that they have a capital loss on the real estate property, they just want to get out from under it, they'll sell off that property. But rather than trying to figure out how to avoid the taxes, they try to take that loss and use it to offset some gains they've had in the stock market. So they might not just sell off the property, but also sell off their stocks to say, wait, this might be my opportunity because I may not get this kind of write-off again. Let's sell off some of my stocks that I had gains on, and I'll have the losses in real estate to offset them so they cancel each other out. Great strategy to use. Once again, I'm going to say this as the disclaimer every time, talk to your CPA. Talk to your CPA first, because you just never know if that's going to be the best strategy. Now, I will give this warning for CPAs. CPAs often will be very narrowly focused on trying to save you on taxes. They might just say, well, no, you don't want to do that because you'll pay money in taxes. But what if it saves you money in taxes? That might be worth it, right? So there are exceptions to this rule. Just be careful that when your CPA says, well, hey, you're going to pay tax. Well, it doesn't matter. Will I pay less than if I did it normally is the real question, right? That's the thing. Will I save more doing this strategy than I would if I waited till a later date to do this. So if you get those capital losses, awesome. I would take that as an opportunity to make a benefit from those other capital gains, so then I've got more money I can work with and then use that to reinvest to make more money off of. Now, there are some other strategies you can do too, because many times people, especially with real estate, will say, well, wait a minute, I don't have a passive or capital loss. I actually have a capital gain that I have to worry about. Now, there are some occasions where, again, talk to your CPA, there are some occasions where even the capital gain isn't really enough to worry about, because like I said, sometimes there's like 0 or very low percent type of tax that comes out. It may not be worth all the hassle to try to do a tax-free transfer of that equity. And so, in some cases, you might just sell off property and be done. There's one time, actually, my wife and I did that. We sold off a couple properties, we had some capital gains, but we didn't bother trying to move it tax-free, doing what's called a 1031 exchange. We didn't bother doing a 1031 exchange because we just didn't see any good opportunities. We didn't want to have to throw, money that was decent, that was good, into something that wasn't so good, right? And not be forced into it. So sometimes, there are exceptions to the rule. You may not care about paying tax. In fact, here's great advice I can give you that's worked for me wonders over the years, especially for helping me avoid losses, is do not let the tax tail wag the dog. Meaning, don't just let taxes be the only reason that you do something, because you're like, I don't want to pay taxes, so I'm going to do this. Don't go into bad investments just because you're trying to save on taxes. It's not worth it. Many people ask me about like opportunity zones, and I'm not going to go into detail about that, but the OZs, right? That's different than the OGs, right? We got the opportunity zones, the OZs. They'll say, well, I'm going to go into this deal. Okay, well, does it pay you much income? No, not really. It's actually horrible. Well, why go into it? I'd rather make more income and pay tax than make almost no income just trying to save a little bit of tax. You get what I mean by that, right? So don't always just do things for tax savings. But all things being equal, yes, we can do that. And that's where a 1031 exchange can come in. If you have capital gains, right, you can move money from one place to the next. Now, it has to be like to like. So you can't, for example, try to sell off money that's real estate, make all these gains, and then put it in the stock market. They won't let you tax-free transfer that. Doesn't work that way. It has to go into something that's real estate related. Just like if you sold off a business, it has to go something that's business related, which there are a lot of variety of ways to do that. With real estate, it's no different. You can actually tax-free exchange into another property. Here's the deal. With the current rules, again, these can always change, right? But you have roughly a 6-month period to get the full process done. So from the date that you sell that property, that's when the clock starts ticking. So from that date, all of a sudden you have now 45 days to pick your property, right? Where is that money going? So you do have 45 days, but that's not a lot of time sometimes. But if you have the right connections, the right relationships, it can work really well. That's one thing that a lot of our clients have got benefits from, because they say, hey, I'm about to sell this property, where do I move it? And we have so many different options, so many different type of real estate options they could do with different providers or investors that they can go with, that they don't actually have to worry and stress about it as much. And so yeah, you can move that money over, that equity over, into another property. So you pick that property in the first 45 days, then you have the next 4.5 months to close on that property. Now sometimes it doesn't even have to be the same kind of property. If you sell a single family home, you don't always have to buy a single family home. Maybe you could buy a duplex with it. Maybe you can go into an apartment building. Again, here's the thing to be warned about. If it's an apartment where it's like a syndication, you have to meet certain requirements. So just be aware, you could do it, but not all syndications, like apartment, syndication where you pool your money with other investors, not all of them allow you to be that kind of partner. So you got to be careful of that. I've even had clients move their money from a rental property into something that's like land, where it buys into something that gives them royalties from oil and gas drilling and things like that. So you can even go into a different type. It's still real estate based, but it can go into a different kind of investment. So if you can't find a good property to move into, maybe you do a different kind of investment that still classifies and qualifies for you to get that tax-free exchange. And that's the beauty of those 1031 exchanges. You realize that you can move it from one to the next. Now, if you sell that investment later on, the one you move the money into, once again, those capital gains are in play, and it's for the full amount, not just the capital gains from before, but from the capital gains on the new property you did. And so what do? You do it again. You move it over again. Yes, it is actually possible that you can go the rest of your life paying no taxes on that property by just doing that 1031 tax-free exchange. Now, it can get kind of crazy after a while, and maybe you want to pay tax down the road, maybe you don't. But the thing is, you can keep that going, and then if you die, here's the great thing. With current tax laws, again, this will get changed next year, but with current tax laws, you could pass it on to your family members, and then they get it not at the old amount, they get it at the new amount. So if they sell it to you at a place where, say that property maybe was $100,000 of gains you had, and eventually it gets up to $1 million of gains, well, when you pass on that property to your heirs, the great thing is that number resets to zero. So that $1 million is now gone. Now you're at zero again, and now it's whatever gains they get when they own that property. So it's possible you could potentially make this go tax-free for generation after generation, creating massive wealth for you and a legacy that lives beyond you. All right, so if you're wondering, hey, should I sell property or not? One cool thing we have on our website at moneyripples.com is a passive income calculator. There's a lot of things, well, just a few questions you fill out there, but guess what? Some of it talks about the equity. Maybe it's time to sell some of these properties to be able to make more. You can find out how much passive income you could create in the next year by using that passive income calculator. Go visit moneyripples.com right now.